Good afternoon, everybody. I'm going to do a quick presentation into trading butterflies. So what is a butterfly? A butterfly spread is a spread between two adjacent calendar spreads, such that the body of the spread is shared by both calendars and the wings of the spreads are equidistant apart. The spread uses futures contracts from three different expiration months with the form long 1 near-term contract, short 2 mid-term and long 1 long-term, giving us the ratio 1 minus 2, 1 and vice versa if we are selling the butterfly. So why do we trade butterflies? In general, butterflies are a good way to reduce risk since you have double the protection of trading the spread of two calendar spreads. It also lowers the margin required, gives us more flexibility than outright futures, and allows you to adjust positions to hedge and rescue certain positions. E.g., you can convert a calendar spread into a butterfly by simply selling the next calendar spread to the one you're in, as well as doing the reverse, i.e. going back from a butterfly into a calendar if you've got one. It also allows you to switch directions of calendar spreads. So if you are long a calendar, you can simply sell the butterfly and this will put you short the adjacent calendar spread. So some butterfly examples. Any futures contracts with different delivery stroke maturities can be traded as butterflies. The most common butterflies are traded in energies, in particularly oil, agricultural products and financial products. Butterflies range from 1 month wide to 2 years plus wide. The main reason why I trade them personally is to find more range bound spreads, as I'll demonstrate next. So here is an oil butterfly where we had the November-December Brent calendar with a range, well if you call that a range, it's more of a directional move, 48 ticks, and the November-December Jan Brent fly 1 month, and here you can see that the range has now been reduced to 7 ticks. So as you can see, it's been reduced dramatically, and since it's more range bound, it's more easy to predict direction, giving more higher probability scalps. So here, like in the fly, I'll be looking to sell anywhere above -11s and go long around -14, -15, trying to nick 2-3 ticks each time, and doing it with a bit more size, so it's a bit more predictable. And here's another example. Here's a soybean butterfly, and here we got the November-Jan soybean calendar, and this has been range bound from the period I looked at, and here we got a 27 tick range. But by selling the Jan-March calendar to make it a fly, the range has been reduced in half, so making it a bit more predictable and a bit more confident to make the trades. So in terms of execution, what's the best way forward? The simplest execution method is to enter by the exchange listed spread, which can be found on the spread matrix. Here you will have no execution risk as it's executed all as one product. So here you can see that on the matrix that I have up here, that we have the butterfly and all the price of the bid and ask for all of the ones that are in the book. But you can also enter by spreading the individual calendars. So if you don't want to get in as an individual product, which sometimes you can't do, for example on Brent, I believe you can't do exchange listed butterfly, so you'd go in by doing spreading two calendar spreads. Or finally, if you're a bit brave, you can try getting in on individual legs. Now this has a bit more risk, but can give you a better price if you can manage to execute it correctly. But generally you would be getting in on individual legs in products that don't move as much. So for example, the Euribor short sterling or euro dollar spreads. So the argument of butterflies over calendars. So like I said before, it's good to use when the range is very erratic in calendars. It provides a better hedge to your existing positions as well. However, it is much more expensive to trade as it requires 3 legs, so it effectively costs twice as much to trade as a normal calendar. And also, by doing the butterfly on some spreads, the ranges are very, very tight, and so it's not really a profitable strategy when you take into account commissions. And one last thing, a slight variation on the normal butterfly is the broken wing butterfly. And this is simply a butterfly where the distance between the body and the wings aren't equidistant apart. So for example, a CL future spread taking the form 1 November 14 minus 2 Dec 14 and 1 Feb 15 would be considered a broken wing butterfly, as we have essentially 1 month calendar against a 2-month calendar. So there's no real rule on which kind of fly to use. Personally, I just use the ratio which helps produce the most range bound spread. So these can change over time, but whichever one gives me the most predictable chart and as less directional as possible, that is the one that I'll generally go for. Until next time, good luck with your trading.